While most investors were distracted by headline inflation prints, central bank speeches, and the daily churn of equity volatility, something critical shifted in the background of the metals market. It didn't ring a bell. It didn't trip a circuit breaker. It didn't look like a crash. But it changed how silver moves through the global financial system. In one sentence, the core event is this. A sudden contraction in available liquidity across physical and derivative silver markets forced a rapid repricing of risk, revealing that far more claims exist on silver than can be comfortably settled under stress. This is why calling it a crash misses the point. Crashes are emotional. This was mechanical. The crowd is missing it because silver is still quoted in dollars per ounce on a screen. The price may move 2%, 3%, even 5% in a session, and look ordinary compared to tech stocks or crypto. But underneath that calm surface sits a layered market structure: futures, options, swaps, ETFs, unallocated accounts, vaulted bars, and industrial supply chains. Most of the exposure is not metal, it is promise. And promises only work when liquidity is abundant. What changed was not sentiment, it was capacity. Across major trading hubs, New York, London, Shanghai, participants quietly adjusted margin terms, delivery windows, inventory access, and internal risk limits. These are not press release events. They appear in footnotes, exchange circulars, and dealer policy updates. But they act like valves in a hydraulic system. Tighten them, and pressure has to go somewhere. The forcing mechanism here is simple. Higher global interest rates and tighter funding conditions have made it more expensive to carry inventory, roll futures, and warehouse risk. When overnight funding moves from 0.25% to 5.25%, the economics of holding 100 million ounces of metal change. A 5% annual carry cost on $25 billion of silver inventory is $1.25 billion per year. Someone has to absorb that. At the same time, industrial demand, solar, electronics, power infrastructure has become less flexible. A panel manufacturer cannot substitute copper for silver overnight. That creates a rigid demand base colliding with a financial layer that is suddenly less willing to intermediate. The result is a liquidity event, not a single-day price collapse, but a multi-layer stress where bid-ask spreads widen, lease rates spike, and delivery optionality becomes expensive. Estimates of notional exposure tied to silver derivatives, ETFs, and unallocated accounts range from $300 billion to over $600 billion, depending on how broadly one counts synthetic and off-balance sheet claims. Only a fraction of that is backed by immediately deliverable metal. That gap is normally invisible. Liquidity hides it. What's at stake is not just the silver price. It's whether financial markets can continue to treat a scarce industrial input as if it were a frictionless digital asset. If that assumption breaks, the consequences ripple outward. Hedging costs rise for manufacturers, collateral demands increase for banks, and volatility bleeds into adjacent markets: copper, gold, even short-term funding. Now here's where it becomes dangerous. Liquidity events don't announce themselves. They begin as small operational changes: a 2% margin increase, a one-day extension on delivery, a temporary suspension of certain account conversions. Each is rational in isolation. Together they form a choke point. This is the part most people miss. Prices move after plumbing fails, not before. Before we go further, a brief but essential disclaimer. This analysis is for educational purposes only. It is not financial advice. Markets involve risk, including the risk of loss. The numbers used here include estimates and scenario ranges, not guarantees. Always consult qualified financial professionals before making decisions. In the next chapter, we'll open the hood and show how the silver market actually works, how futures, inventory, and funding link together, and why a liquidity squeeze can move faster than any headline ever could. To understand why this wasn't a crash but a liquidity event, you have to understand how silver actually trades. What most people think of as the silver market is really three overlapping systems: the physical supply chain, the futures and options complex, and the balance sheet machinery of banks and dealers that connect the two. Start with the futures market, primarily COMEX in New York and OTC forwards in London. A standard COMEX silver futures contract represents 5,000 ounces. At a price of $25 per ounce, that is $125,000 of notional exposure per contract. Open interest frequently sits between 130,000 and 170,000 contracts. That implies 650 million to 850 million ounces of paper silver, roughly $20 to $27 billion in notional value at $25. But COMEX registered inventory, the metal actually available for delivery, often ranges between 30 and 40 million ounces. Eligible inventory, metal that exists in approved vaults but is not committed for delivery, might be 200 to 250 million ounces. Even if you include all eligible metal, you are still looking at a paper-to-physical ratio of roughly 3.1 to 5:1. If you look only at registered metal, the ratio can exceed 15:1. This structure works because most contracts are never settled in metal. They are rolled, netted, or closed financially. That is normal. Liquidity is the lubricant that makes this safe. Participants assume they can always roll forward at a modest cost. Now introduce higher funding rates. When overnight financing was near zero, carrying a long futures position or holding physical inventory was cheap. A dealer could warehouse 10 million ounces, $250 million worth at 25, and finance it at 0.5%, that is $1.25 million per year. Trivial in institutional terms. At 5%, the same position costs $12.5 million annually. At 6%, it is $15 million. That cost flows directly into spreads, margin requirements, and willingness to intermediate. At the same time, exchanges respond to volatility and funding stress by raising initial and maintenance margins. If margin on a silver contract rises from $9,000 to $12,000, that is a 33% increase in capital required per contract. A fund holding 20,000 contracts suddenly needs an additional $60 million in cash collateral. That money has to come from somewhere, often from selling other assets. This is how a mechanical squeeze begins. Add the ETF layer. The largest silver ETFs collectively hold between 600 and 700 million ounces. Those shares trade like stocks, but the creation and redemption mechanism depends on authorized participants who deliver or receive physical bars. If dealers become balance sheet constrained, that arbitrage weakens. ETF shares can trade at premiums or discounts. That is a liquidity signal, not a sentiment signal. Then add unallocated accounts in London. These are effectively IOUs. They are claims on pooled metal, not specific bars. In normal times, they behave like cash. In stress, they behave like unsecured credit. Here is a simple numerical example. Assume a bank has 50 million ounces in unallocated client liabilities and 15 million ounces in allocated physical backing. In calm conditions, that is fine. Only a small fraction ever request allocation or delivery. But if even 10% of clients request conversion, that is 5 million ounces. The bank must source metal in the spot market. If spot liquidity thins and lease rates spike from 0.5% to 4%, the cost of sourcing that metal rises sharply. Now multiply that across several banks simultaneously tightening risk. This is the heart of the mechanism. Silver is priced as if it were infinitely rollable, but it is physically finite. When funding tightens and balance sheets shrink, the market must reprice the right to defer delivery. What looks like a price move is actually the market charging more for time. Every liquidity event has victims, but they are rarely the people watching price charts. They are the institutions sitting inside contracts, deadlines, and regulatory boundaries. In silver, the pressure concentrates in three groups: leveraged financial players, intermediaries with balance sheet constraints, and industrial users who cannot pause production. Start with the leveraged side. Hedge funds, commodity trading advisors, and proprietary desks often operate with 5.1 to 15.1 effective leverage through futures and options. A fund controlling 50,000 COMEX contracts, 250 million ounces of exposure, may only post $600 million in margin against over $6 billion in notional risk. That structure is stable only as long as volatility remains moderate and margin requirements remain predictable. When exchanges raise margin by 25%, 40% during a volatility spike, that fund faces a binary choice: post tens or hundreds of millions in additional collateral immediately or reduce exposure. There's no third option. Cash must be wired same day. If liquidity in other markets is also tight, the only source is asset sales. That is how silver stress becomes equity stress, bond stress, or crypto stress. This is not panic, it is arithmetic. Now move to the intermediaries: bullion banks, market makers, and large dealers. They sit between producers, refiners, manufacturers, ETFs, and speculators. Their business model depends on turning inventory quickly and funding cheaply. Higher rates and regulatory capital rules reduce how much metal they can carry per dollar of equity. A dealer that once ran a 20.1 inventory to equity ratio may now be limited to 10.1. If it previously warehoused $2 billion in metal on $100 million of equity, it may now be capped near $1 billion. That is not a choice. It is a constraint. The dealer must either shrink activity or demand higher compensation for providing liquidity. Bid-ask spreads widen. Lease rates rise. Optionality becomes expensive. Then there are the industrial users. Solar panel manufacturers, electronics firms, and power infrastructure suppliers consume tens of thousands of tons of silver annually. A modern photovoltaic panel uses roughly 15 to 20 grams of silver. Global solar installations in recent years have exceeded 250 gigawatts annually. That implies industrial demand on the order of 150 million ounces per year just from solar. These firms hedge forward to stabilize input costs. Their constraint is operational. A factory cannot halt production because a forward hedge becomes expensive. If hedging costs rise from 2% annualized to 8%, that flows directly into margins or end prices. Either costs are passed on, or production slows. There is no financial engineering solution. This is where the system becomes binary. Either financial players roll and fund exposure smoothly, or positions must be reduced. Either dealers intermediate at scale, or liquidity thins and prices gap. Either manufacturers can hedge at predictable costs, or real-world output adjusts. History offers a useful parallel: the nickel market in March 2022. There, a concentrated short position collided with a supply shock and rising margin. The exchange halted trading after prices moved over 250% in 2 days. The key similarity is not the asset, it is the structure. A small physical market supporting a large derivative superstructure under rising funding stress. The difference is that silver is systemic. It is embedded in ETFs, pensions, industrial policy, and central bank reserves. Nickel could be isolated, silver cannot. This is the part most people miss. No one needs to panic for a cascade to begin. The cascade emerges because every actor is responding rationally to constraints. A fund delevers because margin rose. A bank tightens because capital is expensive. A manufacturer pays up because it cannot stop production. Each decision is locally logical. Globally, they create a squeeze. Liquidity events feel abstract until you reduce them to arithmetic. The silver market stress becomes obvious once you compare physical flows with financial claims, and then layer funding constraints on top. Global mine production of silver typically ranges between 800 and 900 million ounces per year. Recycling adds another 150 to 200 million ounces in most estimates. That places total annual supply in a rough band of 950 million to 1.1 billion ounces. On the demand side, industrial use has grown steadily. Electronics, solar, automotive components, medical equipment, and power infrastructure now consume approximately 550 to 650 million ounces annually. Jewelry and silverware account for another 180 to 220 million ounces. Physical investment demand, bars and coins, varies widely by year, but has recently ranged between 200 and 300 million ounces. Even in balanced years, these numbers leave little slack. In several recent years, analysts have estimated structural deficits between 100 and 200 million ounces, filled by drawing down above-ground inventories. Now layer the financial system on top. ETFs alone hold approximately 600 to 700 million ounces. Futures open interest often represents claims on 650 to 850 million ounces. London unallocated accounts are opaque, but industry estimates commonly place them in the hundreds of millions of ounces. Conservatively, the system may be supporting 1.5 to 2.5 billion ounces of synthetic or derivative exposure against a physical flow of roughly 1 billion ounces per year. That does not mean fraud. It means the market assumes that most claims will never be exercised simultaneously. It assumes time can always be rented cheaply. Now introduce 3 scenarios. Scenario A: normal carry environment funding rates, 1%, 2%, margin. Stability, plus 5%, dealer inventory capacity, high. In this world, carrying 500 million ounces across the system costs perhaps $125 million annually at 25 per ounce and 1% funding. Dealers can intermediate. Funds can roll. ETFs track NAV closely. The paper-to-physical ratio is high but manageable. Scenario B: tight funding environment. Funding rates, 4%, 6%. Margin increases, 20%, 40% dealer inventory capacity, reduced 30%, 50%. Now that same 500 million ounces costs $500, $750 million per year to finance. If dealer balance sheets shrink by even 30%, 150 million ounces of intermediation capacity disappear. That metal must either be held by end users, financed by more expensive capital, or pushed back into the futures curve as higher contango. The market responds by charging more for time. Forward prices rise relative to spot. Lease rates move from sub 1% to 3% to 6%. Hedging becomes expensive. Scenario C: stress event. Funding rates, volatile margin increases, 50% in weeks, dealer inventory capacity, sharply constrained. Here, even a 5% to 10% shift in behavior becomes destabilizing. If just 5% of ETF holders redeem, that is 30 to 35 million ounces. If 5% of unallocated holders request allocation, that could be tens of millions more. COMEX registered inventory in many periods is below 40 million ounces. The system does not have a buffer. It has assumptions. This is why normal expectations fail. Models often treat silver like a liquid financial asset with deep depth at every price. In reality, it is a thin physical market wearing a thick financial mask. When funding is cheap, the mask holds. When funding tightens, the mask cracks. This does not guarantee a price explosion or collapse. It guarantees instability. Spreads widen. Curves distort. Volatility becomes structural rather than emotional. The key takeaway from the math is simple. The silver market is not stressed because demand spiked overnight or mines collapsed. It is stressed because the cost of carrying promises rose faster than the system can adapt. When a market built on rollover assumptions meets a funding shock, price becomes a messenger, not a cause. The reaction looks chaotic because it is multi-layered. What appears to be speculation is usually forced behavior propagating through different asset classes at different speeds. The first transmission channel is spreads. In a healthy silver market, the bid-ask spread on futures might be 1 to 2 cents per ounce. In stress, it can widen to 5 to 10 cents or more. On a 5,000-ounce contract, that is a jump from $50 to $250 per round turn. That cost discourages market makers from standing in the middle. Liquidity thins, price moves farther for the same order size. At the same time, the futures curve begins to distort. In calm conditions, silver trades in mild contango, future months priced slightly above spot to reflect storage and financing. When funding rises and inventory becomes scarce, two different patterns can emerge. If metal is available but expensive to finance, contango steepens. If metal itself becomes scarce, backwardation appears. Near-term prices exceed forward prices. Both are signals of stress. They tell you that time has become expensive or unreliable. Next comes volatility feedback. Higher volatility prompts exchanges to raise margin. A 30% margin increase forces leveraged participants to reduce exposure. They sell. That selling increases volatility, which justifies further margin hikes. This loop is mechanical. No one is panicking. They are complying. As funds de-risk, they often liquidate unrelated assets to meet cash calls. That is why silver stress can coincide with equity weakness, bond sell-offs, or crypto drawdowns. It is not correlation by narrative. It is correlation by balance sheet. Then the ETF layer reacts. In a frictionless world, ETF shares track net asset value perfectly. In a constrained world, authorized participants step back. If they cannot cheaply source or finance metal, they hesitate to create new shares. Premiums and discounts appear. Retail investors interpret this as weird pricing. Professionals interpret it as a liquidity signal. A 1%, 2% premium in a major silver ETF implies that the market is willing to pay more for exposure than the plumbing can deliver at par. That gap is not emotion, it is capacity. Finally, the options market amplifies movement. As price drifts upward or downward through dense option strike zones, market makers must hedge delta. If calls dominate, they buy futures as price rises. If puts dominate, they sell as price falls. In thin liquidity, this gamma effect accelerates moves. What looks like a squeeze or collapse is often automated hedging interacting with reduced depth. Observers often say, "This move makes no sense." It does make sense, just not in a story-driven way. It makes sense in a balance sheet way. What should be watched during this phase? Futures curve shape, contango steepening or sudden backwardation, bid-ask spreads, persistent widening signals dealer retreat, ETF premiums, discounts, sustained divergence from NAV. Lease rates, moves from sub 1% toward 3% to 6%, indicate scarcity of balance sheet or metal. Margin changes, exchange notices raising collateral requirements. Cross-asset stress, equity or bond volatility rising alongside metals. The key insight is that the market is not deciding anything. It is transmitting constraint. Prices gap because fewer participants can stand in the middle. Volatility spikes because hedging flows hit thinner books. Correlations break because the same pools of capital are being tapped across markets. This is why liquidity events feel nonlinear. The system does not glide from one equilibrium to another. It lurches as constraints snap into place. Liquidity events do not resolve in a single session. They unfold in phases, each governed less by news and more by operational reality. Understanding the timeline matters because it reframes what normal looks like. Next 24 hours, the market focuses on surface variables: price, volume, headlines. What actually matters is hidden: margin notices, dealer risk limits, ETF creation activity, and funding spreads. This is when bid-ask gaps widen and intraday volatility spikes without a clear narrative. The key question is not up or down, but can size still move without distortion? Next week. Institutional positioning adjusts. Funds reassess leverage. Dealers reassess inventory exposure. The futures curve begins to show whether time is being repriced. Industrial hedgers test forward markets and report higher costs. Media begins to search for a story, but the structure is already shifting. Next month to quarter, one of three regimes asserts itself. Scenario 1, base case, friction becomes the new normal. In this path, funding remains tight but not catastrophic. Rates stay elevated. Margin remains higher than before. Dealers operate with smaller books. Silver does not explode, but it stops behaving like a frictionless asset. Characteristics: persistent wider spreads, 2 to 3x prior norms, mild but durable contango, ETF premiums occasionally appear. Lease rates stabilize in a 2%, 4% range. Volatility remains elevated relative to history. Key indicators: futures curve remains upward sloping but steeper than before. ETF share creation slows but does not halt. Margin levels plateau. Lease rates stabilize below crisis levels. Industrial hedging continues at higher cost. This is a regime shift, not a crisis. The market adapts to scarcer balance sheet. Scenario 2, stress case. Constraint becomes systemic. Here, funding tightens further or volatility accelerates. Dealer capacity contracts sharply. A modest behavioral change cascades. Characteristics: sudden backwardation. In near-month futures, ETF premiums of 3%, 5% persist. Margin increases exceed 50% in weeks. Registered inventories fall rapidly. Cross-asset liquidation emerges. Key indicators: backwardation in front-month contracts, sustained ETF premium or redemption freeze, rapid decline in exchange-registered inventory, sharp rise in lease rates above 5%, forced selling in unrelated markets. This is not mania. It is a plumbing failure. Either additional liquidity is injected into the system or exposure collapses. Scenario 3, relief case, capacity returns. This path requires a clear change in funding conditions or policy posture. Rates fall. Liquidity windows reopen. Balance sheet costs decline. Characteristics: margin is reduced. Dealers expand books. Curves flatten ETF arbitrage. Normalizes volatility, compresses key indicators. Declining short-term rates. Exchange margin reductions. Curve flattening toward historical norms. ETF premiums disappear. Lease rates return toward 1%. This scenario is not about bullish or bearish. It is about restoring the ability to carry promises cheaply. The big picture takeaway is this: modern markets are not driven solely by supply and demand. They are governed by who can carry risk, at what cost, and for how long. Silver's 600B liquidity event is not about metal scarcity alone. It is about the rising price of time in a world built on deferral. When carrying promises becomes expensive, the market must reprice the right to wait. That is why this was not a crash. It was a structural reveal. As always, this analysis is for educational purposes only. It is not financial advice. Markets involve risk, and outcomes are uncertain. Consult qualified professionals before making decisions.